So the question is, how does this go? Okay, you told me, Neil, that, in when I turn 73 or 75, I'm going to have to withdraw anything pretty much in traditional. And you also told me that nothing has to be withdrawn from a Roth. Nothing, right? Nothing in your lifetime. Then your beneficiaries get 10 years if they're non-spouse. If they're a spouse, they literally inherit it as their Roth and continue that thing until they die. They don't have any requirement for withdrawal for a spouse inheriting a retirement plan. So when I hit either of these two ages based on when I was born, this is when my required distributions start. Now, if I don't want to withdraw this money as taxable money to me, the only option that I truly have at this point is to donate it to charity. Okay. I can donate up to $100,000 of my distribution that's required, right, from a traditional plan to charity to avoid taxes because that distribution is taxable, right? I can only perform this at 70 and a half, which is a QCD. Okay. So why would I do that? Why would I do that? It's because there is taxable distributions that the TSP traditional makes you do that lift you into higher tax brackets in retirement, that create higher Medicare premiums for retirement. So this is why we promote the Roth plan as much as we do, right? Roth plans, again, don't have those required distributions. They're in fact the polar opposite of the traditional plan. The traditional plan gives you a deduction up front, but it makes you pay those taxes later. And boy, does it make you pay that because it requires you at a certain age to start taking that out. And that's about a 5% distribution that must come out each year. And gradually that percentage ticks up. Okay. The Roth plan, even though it gives you no immediate tax benefits right now, allows all of that money to grow tax free and gives you no requirement to withdraw. Okay. Eliminating some risks that you guys are taking by putting everything in traditional and giving yourself this big distribution later. So there are ways that you can get money into a Roth plan. One is through your Roth TSP. One is outside of your Roth TSP via Roth contribution. One is through a Roth conversion. So there's three ways that you as a federal employee can get money to a Roth. You can contribute to your TSPs up to the max, right? Not the max on the screen. It's the max for the TSP, which is 23,500, I believe, for this year. Additionally, you can contribute to an outside Roth IRA, but that's subject to an income limitation for a Roth contribution to a Roth IRA. The income limitation does not apply to the TSP. Okay. So don't get those mixed up. The Roth TSP doesn't have an income limitation, but the Roth IRA for a contribution does. Now I'm about to throw something else at you. There's a third way of getting money to a Roth. That is if you already contributed to a pre-tax retirement plan like a traditional TSP or a traditional 401k or IRA, and you say, look, I put way too much money on that side. I actually didn't think about the fact that this is going to force me to withdraw later and put me maybe into a higher tax bracket. I want to send that stuff out to a Roth. So you can do that. There is no income limitation. There's no dollar amount limitation. There's just an age restriction to do that from your TSP, which is 59 and a half. But keep in mind, if you do that, that transaction is taxed as taxable income. So you don't want to do too much in a year or else you could spite your tax bracket. But if you have a strategy, you can organize a very efficient push into a Roth plan prior to those 70s and those distributions begin. Because let me give you an example. If you plan to kick this can down the road into your 70s and just take your required distributions as they are, you will see very quickly how that can become problematic. Imagine if this is your situation, all right? You have retirement income to the tune of $34,000 each in Social Security. You have a federal pension of 37 and change. Your adjusted gross income in this example is 105 and change. After you take that standard deduction, it drops that taxable income in this case, which in this case, we're kind of treating that as ordinary income, as $75,900. So in this case, this federal retiree would look like they are going to be in the 12% tax bracket. However, there's only about $21,000 of margin between entering a higher bracket. So if you look at this person and they have a $500,000 in their retirement plan, which in this day and age, we're seeing with the stock market's appreciation, people retiring with double that, in some cases, triple or quadruple that. It would be very easy to see someone have a required distribution, in this case it's 73, with some growth rate to their retirement plan that puts them in a higher tax bracket. It subjects them to taxes now on their income, their short-term capital gains and interest at higher taxation rates. This happens all the time. Almost every time we see a tax bracket switch when these distributions begin. Okay. Not only are tax rates tied to it, Medicare premiums on Part B, which traditionally federal employees have picked up and used in kind of a collaboration with their FEHB insurance, those are tied to income as well, which I'll show you, right? However, if you realize this was an issue, you would want to consider getting money out of this traditional plan ahead of this RMD age to curtail this overage on the tax bracket in retirement. I mean, you would be kind of foolish if you were in the 12%. I mean, this is a no-brainer, and you knew you were going to 22. But let's say you're at 22 now, and tax brackets revert back to where they were for that range, which was 25%, wouldn't you just rather pay at 22 than run the risk of 25 or 28 later? Right? And by the way, if you start to move stuff to Roth, whether that's through contribution or conversion, you will impact that future balance that is in that traditional plan. You will lower it, and therefore the distribution that's required of you will be lower as well. And what we're trying to do as financial planners is not necessarily eliminate the RMD altogether. We're trying to reduce the RMD so that it fits within your tax bracket in retirement and your Medicare bracket in retirement and doesn't ruin those tax situation and the Medicare situation for you. And the out product of that is building a tax-free legacy plan for your beneficiaries or emergency plan for you in retirement that isn't going to affect your income as well. Imagine if you needed $200,000 out of retirement and you had no Roth. What do you think? What tax bracket are we going to there? So the output of this is it also gives you a more flexible retirement situation by building that Roth so that you don't dig into that traditional balance all at once and spike that bracket.